For years, Canadians were stuck in a brutal cycle. Home prices rose, interest rates jumped, and down payment targets moved further away. Many gave up before even running the numbers. But what if the math has changed? Just a year ago, a $1.2 million home required a minimum of $240,000 down. Today, thanks to changes in insured mortgage rules, some qualified buyers might purchase that same home with roughly $95,000 down, plus insurance costs. That's a difference of over $100,000 in upfront cash. Welcome to Canadian Wealth Lab. I'll show you exactly how first-time buyers are combining new mortgage rules, the FHSA, and the RRSP, Home Buyers Plan, to dramatically reduce the cash needed to buy a home in 2026. Later, I'll reveal a mistake that can delay your purchase by an entire year, and the one-number lenders care about more than your credit score. Let's use a fictional couple, Sarah and Mike. Relying solely on a standard savings account is one of the slowest, least tax-efficient ways to build a down payment. That assumption used to be true, but it isn't anymore. Instead, they stack two specific accounts. First, the FHSA, the First Home Savings Account. This is arguably the most powerful savings account available. They can each put in $8,000 a year, up to $40,000 total. Every dollar contributed lowers their taxable income, providing a tax refund. Most Canadians completely overlook how aggressive this is. When withdrawn to buy a house, all funds and investment growth are completely tax-free. Tax-free ein. Tax-free growth. Tax-free out. That's $80,000 in potential tax-free room combined. Second, they stack the RRSP Home Buyers Plan. With the withdrawal limit at $60,000 each, Sarah and Mike leverage another $120,000. By combining the FHSA and HBP, a couple can potentially access up to $200,000. If you qualify and aren't using both, you're missing substantial tax advantages. But this doesn't reduce the cost of the home. It changes how you enter it. This is where the strategy shifts and why the current market just turned upside down. Here's where the math actually starts to shift. Think back to that $1.2 million home. Previously, homes over $1 million required 20% down. Today, with the insured mortgage cap raised to $1.5 million, buyers like Sarah and Mike can potentially purchase that same home with roughly $95,000 down, plus insurance. Before anyone starts celebrating, there's a critical warning. Lower down payments mean larger mortgages, which means significantly more interest paid to the bank over time. These rules help buyers get in the door, but they don't erase the debt. Your cash flow must handle the loan. In fact, this leads directly to a massive trap. Most Canadians think saving the down payment is the biggest hurdle. In reality, some spend years saving only to fail the mortgage stress test. Lenders care whether your income supports the payment after rates rise. But this is where the strategy changes again to help buyers protect themselves. Previously, putting down less than 20% locked you into a 25-year mortgage. Not anymore. First-time buyers can now access 30-year amortizations on insured mortgages. Stretching the loan an extra 5 years drops the monthly payment by hundreds, making it much easier to qualify under the stress test. Get this right, and you buy years sooner. Get it wrong, and you spend another 5 years saving cash you never needed. Remember that mistake I mentioned? Many assume FHSA room accumulates automatically. It doesn't. Contribution room only begins once the account is opened. Waiting reduces your future room. Opening it early, even with just $10, is a smart move to start the clock. Once open, follow this strict sequence. Number 1, get a hard pre-approval through a mortgage broker. A broker shops multiple lenders to find the best rate, while your bank only offers its own products. Remember that number lenders care about most? It's your debt service ratio. How much of your gross income goes toward housing and debt? A broker calculates this before you ever bid. Lock your rate for 120 days to protect against volatility. Number 2, budget for closing costs. You need an extra 1.5% to 4% set aside in cash for land transfer taxes, appraisals, and legal fees. For the first time in a long time, some rules are moving in the buyer's favour. The opportunity isn't necessarily bigger incomes. It's understanding the system better than everyone else. These rules won't last forever. Buyers who understand how qualification works today may have a vastly different outcome than those who wait, assuming nothing changed. The down payment is only half the equation. Qualification is what most buyers get wrong. Knowing your exact numbers and utilising these strategies before house hunting could save you months of wasted searching. If you found this breakdown helpful, hit subscribe to stay ahead of the Canadian housing market, and I'll see you next time.